Hello everyone, I'm Yali Jiang. Silver just dropped 11% in a matter of hours. Not gradually, not over days, in one violent move that caught nearly everyone off guard. This wasn't a normal pullback. This was algorithmic liquidation triggered by something deeper happening across financial markets. And what it tells us about the structure of today's commodities trading should concern every investor watching precious metals right now. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. Let me walk you through what actually happened here. Silver was trading relatively stable around $86 per ounce heading into Thursday's close. Then technology stocks began selling off sharply on concerns about artificial intelligence valuations. That equity sell-off triggered margin calls across leveraged portfolios. When margin calls hit, traders don't get to choose what they sell. They liquidate whatever's liquid. And silver, despite being a physical commodity, trades with enormous leverage in futures markets. So here's what unfolded. Equity positions get stopped out. Margin clerks demand cash immediately. Algorithmic systems start dumping silver futures to raise liquidity. Once those algorithms detect downward momentum, they accelerate the selling. High-frequency trading systems pile on. Within hours, silver crashes from $86 to below $77. That's a move you'd normally see over weeks, compressed into one session. Now notice what this reveals about market structure. Silver didn't fall because industrial demand collapsed. It didn't fall because a major mine suddenly flooded the market with new supply. It fell because of cross-asset contagion driven by electronic trading systems responding to equity market stress. This is the modern commodity market. Prices increasingly determined not by physical supply and demand fundamentals, but by capital flows, leverage ratios, and algorithmic triggers designed to protect broker balance sheets. But here's where it becomes important. Despite that violent drop, silver has already rebounded to 76.60. That recovery happened fast. Why? Because the physical market didn't change. The Silver Institute just reported that global demand remains steady through 2026. Industrial applications continue growing, particularly in solar panels and electric vehicle components. Retail investment demand is increasing as investors seek inflation hedges. The fundamental case for silver strengthened, even as the paper price collapsed. Look closely at this pattern. It's happened before. In March 2020, silver crashed from $18 to $12 in days when COVID lockdowns triggered similar cross-market liquidations. Within months, it rallied past $30 because the underlying demand never disappeared. The sell-off was technical, not fundamental. Capital fled temporarily, then returned when investors recognized the disconnect between price and value. What we're seeing now carries that same signature. The Federal Reserve has held interest rates elevated for over a year. Markets had priced in rate cuts starting this spring. Then January's jobs report came in stronger than expected. Suddenly, the probability of a March rate cut dropped to 8%. That shift matters enormously for non-yielding assets like silver. When interest rates stay high, holding silver means foregoing that yield. It creates opportunity cost that pressures prices. Financial markets now see a 92% chance the Fed holds rates steady at the next meeting. But look at June. The probability of a cut by June has climbed to nearly 50%. That tells you something critical. Markets believe this period of maximum restrictive policy is nearly over. Once cuts begin, that opportunity cost reversal could drive significant capital back into precious metals. Now, let me show you why the dollar correlation matters here. Silver trades globally in US dollars. When the dollar strengthens, dollar-denominated commodities typically fall in price because foreign buyers need more of their currency to purchase the same amount of metal. Thursday's sell-off happened as the dollar held relatively firm on those strong employment numbers. But if today's consumer price index data comes in softer than expected, at 2.5%, we could see dollar weakness accelerate silver's recovery. Here's what traders are watching. The CPI report releases in just hours. Consensus expects both headline and core inflation at 2.5% year over year. If the actual number comes in at 2.3 or 2.4, that would signal disinflation is continuing faster than the Fed anticipated. Markets would immediately reprice rate cut expectations higher. The dollar would likely weaken. And silver, priced in dollars, would gain on both the currency effect and the renewed expectation of lower rates reducing opportunity cost. But there's a structural element here that goes beyond short-term data points. Industrial demand for silver is rising in ways that aren't easily reversed. Solar panel production requires significant silver for conductivity. Every panel uses it. Global solar capacity is expanding rapidly as countries pursue energy transition goals. Electric vehicles use more silver than traditional cars due to electrical systems and charging infrastructure. These aren't speculative demands. They're embedded in long-term industrial build-outs already underway. Meanwhile, silver mining supply faces constraints. Silver is rarely mined as a primary product. Most comes as a byproduct of copper, lead, and zinc mining. When those base metal operations slow down, silver supply tightens even if silver prices rise. We're seeing exactly that dynamic now. Base metal production hasn't kept pace with demand. That structural limitation on silver supply creates a floor under prices that algorithmic sell-offs can't permanently break. Now notice what changed in investor behavior. The Silver Institute reported retail investment demand is offsetting losses in jewelry and silverware demand. That shift is significant. Jewelry demand is discretionary and price sensitive. When silver gets expensive, people delay purchases. But investment demand works differently. Investors often buy more aggressively when they believe prices are temporarily suppressed. Thursday's crash likely accelerated that buying among investors who view $77 as undervalued relative to fundamentals. Look at the gold-silver ratio right now. It's trading near historical extremes that have consistently marked turning points. When gold significantly outperforms silver, that ratio expands. Eventually, it reverts as silver catches up. We've seen this pattern repeatedly over decades. The current ratio suggests silver is undervalued relative to gold. If that reversion begins, silver could outperform significantly even if gold prices remain stable. This pattern has appeared before in nearly identical form. August 2023 saw a similar algorithmic flush when interest rate expectations shifted suddenly. Silver dropped from $25 to $22 in days. Within 3 months, it recovered fully and pushed higher. The fundamental demand didn't disappear during the sell-off. It created a buying opportunity for those who understood the technical nature of the decline. What does this suggest about inflation? Here's the reality. Silver's industrial demand is rising because the technologies of the energy transition and electrification require it. That creates persistent demand pressure. Supply remains constrained by the economics of byproduct mining. Those forces suggest structural price support regardless of short-term inflation readings. But if inflation remains elevated above the Fed's 2% target, silver gains additional appeal as a monetary hedge. The metal benefits whether inflation stays high or industrial demand continues growing. What does this suggest about currency confidence? When markets sell off violently across asset classes simultaneously, that reveals stress in the financial system. It shows how interconnected and leveraged modern markets have become. One sector's problem becomes everyone's problem through margin calls and algorithmic contagion. In that environment, hard assets with no counterparty risk gain appeal. Silver is physical, it has industrial utility, it can't be created by central bank policy. Those attributes matter when financial system confidence wavers. What does this suggest about investment psychology? The speed of Thursday's crash and Friday's recovery shows how fragile paper market pricing has become. Algorithms dominate short-term moves, but human investors who understand fundamentals create the longer-term trends. When those two forces clash, you get exactly what we're seeing. Sharp technical sell-offs followed by fundamental-driven recoveries. Investors who recognize that pattern can position accordingly. Here's what matters going forward. Silver has recovered more than halfway from Thursday's low already. If CPI data shows continued disinflation, the dollar could weaken and rate cut expectations could strengthen, both supporting silver prices. If CPI comes in hot, silver might face near-term pressure from sustained high rates. But either scenario leaves the fundamental demand story intact. Industrial consumption isn't changing based on 1 month's inflation data. The Silver Institute's forecast of steady demand through 2026 provides a baseline. That demand comes from sources that aren't going away. Solar installations, electric vehicle production, 5G infrastructure, medical applications. These represent multi-year build-outs already in progress with committed capital. Even if jewelry demand remains soft, investment demand appears to be filling that gap as investors seek inflation protection and hard asset exposure. Mining supply constraints create the other side of this equation. New silver mines take years to develop. Existing operations face rising costs from energy, labor, and regulatory compliance. Byproduct mining economics means silver supply doesn't respond quickly to price increases the way a primary product would. That inelastic supply meeting growing industrial demand sets up a structural tightness that supports prices over time, regardless of short-term volatility. What's happening in the silver market right now is a collision between two realities. The paper market, dominated by algorithms and leverage, experiences violent swings based on cross-asset contagion and technical factors. The physical market, driven by industrial consumption and investment demand, moves based on fundamentals that change slowly. When those two realities diverge sharply, opportunities emerge for investors who can distinguish between them. Silver's role may be changing from primarily a monetary metal to increasingly an industrial commodity with monetary characteristics. That hybrid nature could support prices in ways that pure monetary metals like gold don't experience. If industrial demand continues growing while mining supply remains constrained, silver could see sustained fundamental support, even in environments where traditional precious metals struggle. For investors, this moment crystallizes the essential challenge. Do you trust the paper market's algorithmic sell-offs, or do you trust the physical market's fundamental demand? Thursday's crash and Friday's recovery suggest the answer. Paper moves fast and violently. Physical moves slowly and persistently. The investors who survive volatility are those who understand which time frame they're operating in. The implications extend beyond silver specifically. What we're witnessing is how modern markets function under stress. Leverage amplifies moves in both directions. Algorithms accelerate trends without regard to fundamentals. Cross-asset correlations mean nothing trades in isolation anymore. In that environment, assets with tangible utility and constrained supply become increasingly valuable as anchors in a system built on electronic abstractions. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening in the silver market right now matters more than most people realize.